Trade-offs for longer days to expiration trades. Let's take a look. Typically, our time frame for selling premium is a perfect 45 days, but it's somewhere between 30 and 60 days. How do longer starting D trades compare to our standard 45 DTE trade cycles? Want to take a shot here?
I'm going to say obviously slower moving. I mean, more times going to make the trade slower moving. I mean, that's probably master of the obvious. Less volatility, P&L swings, and I'm going to say not worth the time.
Less volatility for sure. Smaller P&L swings, I agree, for sure.
So I don't think you're going to get, for selling premium, I don't think you're going to get per
less opportunity, less risk.
Yeah.
I'm going to argue it's going to be virtually the same probability of profit. Since 2005, we sold 25 Delta Strangles. We managed all trades at expiration. Since all had different time frames, expiration management is a fair way to compare trade-offs. We compared starting days to expiration of 45, 60, and 75 days. We recorded the win rate, the average credit received, the average P&L, and the largest loss. Here's where we go. We talked about win rates, and I said, you know what? I think the win rates are going to be very similar regardless of the time frame. And the win rates are determined by the delta of the trade. Okay, we know that. But since the deltas of the short strangle are virtually the same throughout the whole study, the win rates are also nearly the same across all days to expiration. It's obviously harder to be more precise the longer out you go. That's why they're a little less than the shorter time frames at 45 days, because with 45 days, you're going to be a little more accurate and there's going to be more volume. You're going to have more efficient markets. It's going to be a little more accurate. The difference between 72 and 69 is not that significant. It's a reasonable distribution win rates. Like I wouldn't call it statistically significant, the difference between 72 and 69. It's just the further out you go, the less accurate those numbers become over time. It's just harder. Markets are wider. The volatility is going to be a little bit off. There's going to be a little more slippage. They're all basically the same. The longer expiration options are more expensive, so the average credits are higher. However, the 75 day to expiration options are 67% longer than the 45 day to expiration trades, but you only collect 22% more. This is a little bit misleading because, of course, this is how it's going to work. The way options are priced going out in time. What I like about what the team did here was that they actually put some numbers around it. So essentially, you go out from 45 to 75 days. That's you're extending duration by X, but you only collect Y, which is a percentage of X. You go out for a longer time, you should get more credits, but you don't collect the same amount of extra credits as you do for the amount of time that you go out. That's the argument.
Right.
Yeah, at 45 days, you collect $400. At 60 days, $427 or $428, and at 75 days, $497. It doesn't feel like you're getting paid for that extra 30 days.
Right.
Now you are, because it is what it is.
Sure.
Because if you didn't think it was a fair number, you would buy it instead of selling.
Right.
I'm just pointing it out, and I think this is a really good point. You don't get enough to take those extra 30 days worth of risk for an extra $90 or 22% of the trade. Further dated options have higher trade by trade P&Ls, but when adjusting on a daily basis, that 75 day to expiration trade was 27% less profitable. Yes, you are going to make more money on the average trade because there's more time. But when you look at the average daily P&L, it's significantly less. You take less risk, daily P&L is going to be less. We're not saying that one is necessarily better than the other. We're just pointing out to you to see where in that distribution curve is the perfect spot. And that's why we like the 45 days.
We're looking for optimal here, right?
Yeah. We're gonna argue the optimal point in the decay curve is where you make $1.04 per day as opposed to 76 or 85. The single and largest trade-off for longer D trades is the lower outlier impact. That's a very fair point. Where do I have the lowest outlier risk? And the largest loss was lower for the 75 DT trades in dollars, as well as a multiple of credit received. So what's interesting here is the top line's what we showed you before in the average credit received, but the largest loss is actually less at 75 days than it was at 45 or 60 days. The largest loss as a multiple of the average credit. And by the way, this number just keeps getting bigger and bigger and bigger until you get all the way down to the 0 days. But the average loss is the largest loss is a multiple of the average credit. At 75 days was 11.6, and at 45 days was 17.2. If you went to, let's say, 0 days or 1 day, it could be 100.
Sure.
Or 50, it could be huge. It's a very different animal. That's an argument for going out longer, is you're just taking less risk. So some of the takeaways here. when you look at 45 days compared to a longer dated strangle, there's no difference in the win rates. You have a lower daily P&L for the longer dated trades. You have lower outlier risk for longer dated trades. That's your trade-off. You make less money, you take less risk. The longer dated premium is generally lower risk and lower reward for the same reason why very short-term option trades are high risk, high reward. So where is the sweet spot? Well, it's somewhere in between. If you're going to take high risk, high reward in the 0 days or the 1 days or the 1 weeks, and you're going to take lower risk, lower reward on the 60 or 75 days to expiration, where's the sweet spot? Well, we've argued for a long time. It's wrapped around that 45 DT.